Welcome to this week's Q&A. I hope all the Aussie expats and Australians in lockdown are doing well today. And I just want to come and say we're all in quarantine here, so know what it feels like and hope everyone's doing fine. This week's question relates to what's been in the news for a while now about the RBA's board meeting today, Tuesday, the 6th of July, and what implications that may have for us as retail borrowers from banks and other lending institutions. And a client of ours said, look, what's going to happen at this board meeting? What impact is that going to have on my choices of interest rates going forward? And this particular person had a couple of loans that were currently on fixed rates coming off later this month, so it was rather pertinent. And I think it's also very timely because the meeting actually just occurred this afternoon, and whilst there was no surprise about the outcome of the cash rate being held at 0.1%, which the RBA has said repeatedly is going to remain that way until 2024 at the earliest, there were actually a couple of surprises in it, and I'll come to that in a second. And the other thing that was expected is that they kept the April 2024 bond as the target date, as opposed to rolling that forward to the November 24 bond. That says a little bit in its own right, but was anticipated by the market. The couple of surprises, I suppose, that came were that the QE that is currently being dealt out to everyone has been changed. It's now going to be a QE that's progressive, and the bank can come back and look at how much or how little of that it wants to do and how it wants to taper. But they're saying that now they're going to be going forward buying $4 billion a week in bonds, whereas the expectation was that was going to be $5 billion, and also potentially that they're going to look at this again in November, which is perhaps a little bit earlier than I thought and many people thought would happen. And that is the new review date, so there may be a reset there, who knows, it could come down to $3 billion per week and then $2 next year until it expires in May. So there's a bit more of a hawkish tone, I guess, in general, which is something that most people have anticipated because the economy has bounced back very strongly. Unemployment's down to, almost pre-pandemic levels. So that was to be expected. And the other thing was there's a bit more of a change in terms of the forward guidance, a little bit more hawkish when the terminology at the earliest has been removed. So it's still 2024 in terms of what the RBA is saying for rate rises, but at the earliest has been removed. And many of the bank economists are now predicting that those rate rises may come in 2023 and some even in late 2022. So that's something that we need to keep an eye on. But for this person's question, and I guess for all of us out there as retail borrowers from banks, we've got to look at this and say, well, what's going to happen to the interest rates that we are paying? And if we look at, I guess, what people are doing in the marketplace at the moment, a lot of people, whether they be homeowners, i.e. owner-occupiers, or investors, are looking to lock in fixed rates. And I think that's probably not a silly thing to do at all, because we can still avail ourselves of very, very cheap rates when you look historically at this point in time to give us some peace of mind and know how much we'll be paying in interest going forward for, say, the next, whether it be 2, 3, 4 or 5 years. And particularly the 2 and 3 year rates are still very, very low. But look at things, everyone has their own personal situation, and this is only general information, not advice, but people need to have a look at that. And if they're going to keep that property for a long time, potentially look at a 5-year fixed rate to take advantage, I suppose, of a longer term, even though they're paying somewhat more than perhaps someone is going to opt for a 2-year rate, but they want that peace of mind knowing that they're going to be paying whatever the going rate is with their lender over that period of time. So all in all, I think today's board meeting has probably just underlined the fact that we've seen the bottom of the fixed rate interest cycle, and some of those rates have already been nudging up a little, and I anticipate to see more of that in the coming weeks and months. So it's not too late, and I think people should look at their own circumstances and see if potentially a fixed rate is a good idea for them. And on that note, I look forward to receiving everyone's questions. We'll pick something else that's, pertinent and topical again for next week, and wish everyone all the very best. Look forward to seeing you at next week's Q&A. I'm Andrew Unterweger from Wise Guru.